Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Let's take a look at Nike. What the heck is going on with these guys? Stock is down almost 20% in the past 5 days. Not a good performer in the last couple of years for sure. This has been a tough tenure for CEO John Donahoe, who started around January 13th, 2020, and the stock is down about 20% since then. The stock is down about 12.5% in the past 5 years. When you consider the fact that retail ETFs are up about 50 to 60%. The S&P 500 is up about 60 to 70%. Basically losing money in that same time period as a shareholder of Nike. Not a good sign. I think John Donahoe's days are numbered, and the stock is down for a good reason. This is the fifth time in the last 6 earnings that these guys have guided below what the market expected, and that is not a good trend at all. Basically, the competition is fierce and Nike isn't doing well when it comes to facing that competition. If you look at the earnings themselves, up about 1% for the full year doesn't seem that bad, but as you look at the trend, Q4 earnings down 2%, so deaccelerating, and then guidance into 2025, even worse. Q1 guidance negative 10%. Not good at all. If you're looking at what's driving the reduction for Q4, Nike direct revenues are down 8% versus wholesale, which is up 5%. And that's interesting because Nike Direct has been a growth driver for these guys for quite some time. And to see that down 8% shows that people are not interested in their product as much as they used to be. Wholesale being up 5% kind of makes me think that maybe they have oversupplied the wholesale market and maybe some of that will come down in the first quarter as is shown by that guidance. So their strategy has been to kind of drive people to their website to get sales growing there. But what that does is it pisses off your wholesale partners a little bit because now suddenly people are buying stuff on your website. They're not buying it in their stores. And now they have more shelf space to give to other people who are maybe more willing to work with them. You've got companies like Deckers, you've got companies like Hoka, shoes like Hoka by Deckers rather, companies like On Running that are doing really well because they've taken advantage of some of the missteps that Nike has done in this space. Nike's focused on some of their classic brands. They've really missed the trend of people going into running, moving into running, buying running shoes. They've fallen behind there, lost market share. On top of that, in their classic brands, which are really kind of focused on like that basketball lifestyle space, they've oversupplied those. That's driven away some of those sneaker collectors that are a big part of their business. Now they're trying to work down that supply, making sure that that business stays healthy. But a lot of that damage has been done. You kind of can see that in the trends that they're seeing. 1% growth on the footwear side, trending down towards negative 4% in Q4. Not a good sign at all. That's kind of the case for most of their areas. Greater China was actually pretty flat, which is interesting to see given that some of the guidance that they're giving for Q1 is that Greater China is suddenly falling off a cliff, which is interesting to see given the results for Q4. So you kind of think about some of the results they're giving. If you listen to the call, it's pretty optimistic for the first part. It's like, hey, we're doing a lot of innovative stuff. We're doing cool things, a lot of amazing things. And really, whenever I hear about innovation in the shoe space or the apparel space, it's like, wow, I mean, what are you doing? Are you really doing something amazing on the shoelace front? What's going on here? Tell me about it. I think they really missed some of the innovative stuff that other companies have done, and now they're trying to catch up and they're trying to kind of sell their business because you can kind of see that they saw some double-digit growth over the past several years. The lifestyle business kind of started to fall off. The digital business fell off quite a bit. This has been a business that grew 26% since 2019. That's 26% per year since 2019. Now suddenly it's kind of falling off a cliff. China's falling off a cliff. So really big headwinds that suddenly happen after Q4. Obviously Q4 was kind of important to that, showed it a little bit, but now Q1 is really moving in a pretty big direction because suddenly it's like, well, we went from -1 growth quarter over quarter in Q4 to -10 growth projected for Q1. And that really shocks the market. And that's why the stock is down as much as it is. So they talked about how their classic footwear, they're going to tighten their total supply, kind of make it so they're more unique, more rare, get more people interested in buying stuff at full price again. They talked about how they have to release new styles in different markets, react to the consumer. maybe it's a little bit too late for that. I think the concern for me with these consumer brands is always going to be when you talk about stuff like shoes, clothing, etc. Once you move off of a certain brand, it's sometimes difficult to come back. Like, hey, I switched from Adidas to On Running. I'm basically buying On Running shoes for the last couple of years. I'm probably not going back to Adidas. I may switch to something else, and potentially it's going to be Nike or Adidas. But right now, there are 0 Nike items in my house. My wife does not wear it. I don't wear it. I don't know if any of my friends wear it. Actually, I heard about On Running from people at work. They weren't telling me about Nike. They were telling me about how great these On Running shoes were. So something is going right there and something is going poorly here because Nike is a huge brand. They should be using their brand name to compete well against some of these other shoe brands in the running area, and they're just not doing it well at all. So as you look at some of the guidance that they're giving, again, very, very pessimistic look at 2025, negative 5% growth, and this is basically kind of the growth they saw during the heart of the pandemic. Not a good sign. Q1 negative 10% growth, really, really poor. I don't think investors were happy to see that. Continuing challenges on digital, muted wholesale order books. Again, if you see 5% growth in Q4, and that's outrunning what you're doing on the direct-to-consumer side, probably going to turn negatives on the following quarter, following year, because the supply is there and they don't need any more when sales are dropping. Newness of their new stuff not there, softer outlook in China, and a number of other things just not looking great. And that's interesting, especially with the Paris Olympics out there. You would think some of that sports stuff would carry through into interest in some of their brands, but it's really not. And that's a bit depressing. But again, besides all of those negative things, this is still Nike. Great balance sheet, $11.5 billion, about $7 billion, $8 billion in debt, $2.5 billion in capital leases. Cash flow really solid. We're talking about a company that produces $5 to $6 billion in cash flow every single year. From a valuation perspective, this is a dividend payer. So if you're interested in dividends, you're talking about this being as high from a dividend yield perspective as it's been in quite some time. And this is a company that's raised their dividend 20 plus years running or so. They've raised their dividend about 10 to 11% in the past couple of years. I'm assuming that's going to be the case going forward. About 50% of their free cash flow goes towards dividends. The other half probably usually goes towards stock buybacks. On a normalized PE basis, we're talking about getting to 5-year lows again. Mean in the last 5 years at about 33x. But again, that mean is kind of iffy because there was a period of time where the stock was trading at 50x, probably shouldn't have been. If you go 10 years out, that mean goes down to 29x, and again, still includes those 50x years. If you kind of exclude the period of time that includes the pandemic years, you're talking about a mean that's closer to 23, and it's trading at a 23. So maybe it's trading where it should be in relation to all of that stuff. But again, it's still Nike. You go back to 2008 during the recession, companies were doing really poorly. They actually kind of grew during that time period. 2% in 2009, basically flat in 2010, 10% in 2011, positive net income, positive free cash flow, continued to grow their dividend. If you look at 2020, yeah, they shrunk a little bit, but positive net income, positive free cash flow, continues to grow their dividend. This is a company that's got a history of doing well during good times and bad, and that's why people are interested in it. And maybe now is the right time to buy it given the valuation it's getting. As we look at the valuation again, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. So as we look at the valuation here, again, 114 billion market cap. Debt is basically flat when you consider the cash on the books versus debt and capital leases. This is a company that's bought back shares outside of 2021 for the most part. This does include stock-based compensation. So you're talking about an average of about $3 billion a year in stock buybacks. This free cash flow for 2024 is kind of an assumption, an estimate based on what they said during the earnings call. They don't actually release a statement of cash flows until like 2 weeks after their call for whatever reason, but I think it should be pretty close, but FYI. So the free cash flow yield here of about 5.6%. This has some working capital benefits. It's probably closer to 4.5% on a go-forward basis. On a dividend basis, I'm kind of assuming about 8% growth. You can adjust this if you want. You can always play around with a spreadsheet file, make a copy. There will be a link in the description down below. 8% growth for the next couple of years. If you look at the free cash flow payout ratio, about 50% given the assumptions I'm making. From a growth perspective, I'm assuming that negative 5% growth next year, margins in the 9.5% range, and then returning the growth again, 4% growth for the next couple of years down to 3% growth with expanding margins. And maybe that's a bit optimistic on the margin expansion, but I think they can kind of settle in that 11% range. That's kind of been their historical norm outside of the pandemic here. You're talking about 11 to 12% range here, about 10 to 13% range here. So on average, it's kind of in an 11% range here. Seems reasonable to me. As you look at the growth here, again, in 2026 fiscal year, you're basically getting back to just slightly below where you are this year. So that's not crazy. I'm not expecting them to suddenly blow it out of the water. I'm assuming that 2025 next year is going to be mediocre, and then 26 is kind of going to get back to where they were this year. Not anything crazy, but if you want to play around with these numbers here. And as far as buybacks go, I'm essentially saying that, hey, you're going to issue about $13 billion in dividends. Everything else is going towards buybacks. Maybe they'll borrow money to get more buybacks in there, but you can play around with this. Pretty big buyback yield here, pretty decent dividend yield here. That's kind of where the money's coming from. I don't think this is going to grow at a rapid clip. There's so much competition. They kind of have to retool their business. If you feel differently, obviously you can make more aggressive assumptions on revenue growth. But again, ask yourself this question. Do you have a lot of Nike stuff in your closet? Do your friends? Does your family? I don't think my circle does. And maybe that's a sign of what is happening to this business. There's more competition than there ever was. There's a lot of different brands at different price points, and Nike is going to have to face that. Lower price shoes, more focus on running, lower supply on some of their marquee names, making sure that that remains a full price item that has brand cachet, etc. Releasing different things that appeal to different people is going to be key, and they've kind of missed the boat on that. As I look at valuation, again, 4% free cash flow yield for a company like Nike seems reasonable even as growth slows. Maybe 5% is where it's headed ultimately given slowing growth, but that's yet to be seen. I'm putting 80% on 4%, 20% on 5%. You can play around with these. As I take that valuation into perspective based on today's price point of 76.04, I get about a 9.2% return after buybacks, after dividends. 4 to 5% of that is coming from buybacks and dividends. The other 2 to 4 is coming from growth that they're going to get, margin expansion, growth, etc. It's obviously not going to happen next year, but it has to happen the year after. They have to figure out what's going on with the business. And that's assuming, again, the $73 fair value that I'm getting here kind of assumes an 8% target return, about a 2% yield from there. So a total return of about 10%, so slightly below where it's trading today, kind of getting to the 10% return. If you feel differently, if you feel this should be valued at about a 5% yield, you can kind of see you get a 6% return there. If you think 4% is the right way, about a 10% return there. If you feel like even 3% because of how marquee this brand name is, you're talking about a 15% return. That's probably a bit optimistic given where the growth is headed, but you do you. It's all up to you. This is kind of a educational video to have fun with. Play around with the spreadsheet. For me, I already have exposure to consumer brands, Apple, Amazon, CROX, and again, CROX, also a shoe brand, also growing kind of at a similar clip, similar margins, maybe even slightly better margins than Nike, and yet still getting a multiple that's well below where Nike's trading, even after rising 70% since I bought it. So Nike's trading at a 4% free cash flow yield because of the long-term nature of its brand. But if there's struggles ahead, the risk and worry is always going to be, well, if this multiple shrinks, if it goes to 5%, you're talking about a 6% return. If it goes to 6%, probably won't because it's Nike, you're talking about a 3% return. And you're talking about fair values in the $50 to $60 range. Not saying it's going to get there, but that's something you have to consider as an investor. So as I look at something like this, because of all the other exposure I have to consumer goods and the weakening consumer that there is right now, maybe Nike doesn't seem like the best fit for my portfolio right now. On top of that, I feel like this is a stock that's kind of going to hang around where it is right now. I mean, what's going to drive this price upwards? The market kind of looks at this and says, well, Q1 is going to be terrible. If it's going to be negative 10, maybe we should just wait and see what they say about Q2 during that call. Because if it's terrible still, maybe this negative 5% isn't even going to be a thing. And remember, 5 out of the last 6 earnings calls, their guidance was worse than the market expected. And if that's how this CEO operates, maybe that's what you're going to get. And maybe the answer is they need a new CEO. And I wouldn't be surprised if the CEO change happens in the next 6 to 12 months, because after all, if you're talking about Nike, this marquee brand out there for 5 years, getting you a negative 12% return on price, maybe a 0% return after dividends, not good work from the CEO. So for me, if I wanted to buy this, where would I buy it? Probably something in that like low 60s, mid 60s would get me interested. If it goes into like the 50s, I'd probably be very interested. Is that going to happen? Probably not. I don't expect it to, but that's just what it would take for me to get this into my portfolio. I would need this to be a deep value situation. It's just not. I feel like right now it's probably just fairly valued based on what we know about the stock, based on where it's headed. And that's my take on it. If you disagree, let me know down below. What do you think about Nike? Do you have Nike stuff in your collection? Are you a Nike shoe collector? Do you have a lot of their clothing? Do you think they make good products, bad products? Have they gotten worse? I've heard that generally their products have gotten worse. That's just kind of the, from my mild research around people who collect stuff or are wearers of Nike. And I think that's just generally the case with a lot of clothing. So it's not a surprise that their products have gotten worse. That's just, stuff gets more expensive and they spend less money on it so they can make more margins. That's kind of the norm with consumer goods. But if that becomes the trend here and other competitors make better stuff at similar prices or even lower prices, and you can't get back to where you were from a brand cachet perspective, maybe Nike's going to struggle. So let me know what you think down below. Comment, leave a like, subscribe, all of that good stuff. Thanks for watching, and as always, I look forward to hearing from you, and bye!